All right, that was a interesting opening to our discussion today about real estate investors. Thank you to Jordan Davis for making that song. Okay, welcome everybody to today's webinar. This is So You Want to Be a Landlord, Financial Planning Strategies for Real Estate Investors, Evaluating Real Estate as a Part of Your Long-Term Financial Strategy. So welcome to today's webinar. If you're joining me live, great. Feel free to chime in with any questions that you might have. I'll take some questions at the end. If you are watching this as a recorded video, you're also welcome to watch to the end, give us a call, shoot us an email about anything that might not be clear or might need some further explanation. But I'll do my best to make this as simple and straightforward as possible, given the fact that it's a topic that can be a little bit complicated. So let's jump into it, okay? And just to start off, this is not a real estate sales presentation. The objective of this webinar today is to help you, the viewer, make an informed decision about whether rental real estate or real estate in general fits into your financial plan, and some of the factors that might influence that decision. So that's where we're going. Now, before I jump into it further, I just do want to summarize some important disclosures here. This presentation is for educational purposes only. Sorry about that. I gotta turn something off. It is for educational purposes and informational purposes only. It is not intended to provide and should not be relied upon for tax, legal, or accounting advice, although we do go to great lengths to make sure that our information is accurate and useful. Each individual's financial and tax situation is unique, so please consult a qualified tax professional before making any tax-related decisions. Information presented today is based upon sources that I believe to be reliable as of June 2026. But things change with future IRS guidance and legislation, so just keep that in mind. Okay. All right. So with that important disclosure out of the way, let's just set the stage here. So why does this conversation matter, right? Well, real estate can be a powerful investment and wealth creation tool, but it is not passive. And I hear that term frequently, that people want to get into real estate because it's considered passive income. And we have pretty prominent real estate people that like to promote this particular asset class, and there are various trade-offs that come with it. So let's talk about that. So common expectations when people think about investing in real estate of all types. So they are thinking about monthly cash flow, just that tenant paying that check, getting appreciation on the asset, on the building or home or apartment complex, whatever it is that you're investing in, taking advantage of the tax advantages that may be present through rental real estate, and hopefully that creates some degree of financial independence. Those are the expectations. That's the dream, right? Common realities, right? Things we have to factor in: vacancies. How long does it take for you to re-rent that property once your tenant vacates? Repairs and maintenance, things that you have to fix: toilets, pipes, sinks, drains, all that sort of stuff. Financing risks, being able to properly finance the property. What kind of time commitments does it take in order to manage this property? And again, tax complexities. It doesn't always translate into the tax benefits that you think it might be going into it. So, question is, does being a landlord help you to reach your goals, or is it distracting from them? And so the reason it's not passive, yes, it's passive from the standpoint of maybe the tenant is writing you the check and you're not necessarily directly working the job, or earning wages for that check that they're writing you, but you definitely are earning it. It is not something that does not require involvement. Okay. So what we're going to talk about today, right? Real estate within a financial plan, cash flow versus appreciation, financing and leverage, tax considerations, signs that real estate may not be right for you, some exit and transition strategies, and the decision framework for moving forward. Okay, so we'll cover some various details regarding including real estate in your financial plan. All right, so when you are considering real estate, okay, particularly income producing rental real estate, or I should say income producing real estate, of which rental properties or rental real estate is one type of income producing real estate. You should be thinking like an investor. Okay, real estate is an asset class, just like stocks and bonds are an asset class. So, stocks, bonds, cash, businesses, and real estate, those are all different asset classes that might be included in your portfolio. Okay, so real estate does have some significant benefits, and let's just talk about this. The income, right? So when you own an asset that somebody desires to use, then you can charge them rent. Okay, and that rent is going to be dictated by the market conditions, right? Supply and demand. And there's a phrase in real estate, especially if you're buying or selling a home, right? It's all about location, location, location. So if you have a piece of property or a building or a house in a desirable location, then you're going to be able to command a higher degree of income from that asset than one that's in a less desirable location. Okay. So that's number one. What's the income potential of the asset? The second is oftentimes people buy and utilize real estate as an inflation hedge. And why would it be an inflation hedge? Because generally speaking, people tend to increase the rents that they charge over time as the costs for managing that property increase, right? And I'm sure everybody's familiar with how in recent years we saw a significant run up in rent prices, so the price that you could rent a unit for. A lot of that was in the news. And so that is your inflation hedge. So if you're able to command an increase in the rent that you charge while prices are rising, then you are hedging your inflation risk. You're able to keep up and not have inflation erode your purchasing power. Real estate has leverage opportunities. What I mean by leverage opportunities, that means that you can borrow against it. Okay, it is a physical asset that a bank or other lender might want to or be able to loan you money, loan you capital for the privilege of borrowing against it. It's creating a lien or some form of liability against that asset. And I'm sure you're probably familiar with being able to take out a mortgage or a home equity loan or line of credit on your own home. Well, you can do the same thing for rental properties. There are various tax advantages that come with owning real estate, and we'll go into those in a little bit more in depth. One of them is depreciating the asset that you can't necessarily do on a primary home, but there's others as well. So tax advantages of this asset class as compared to other asset classes. And then lastly, it's a tangible asset. It's something you can put your hands on, you can walk through the door, you can stomp your feet on the floor, you can touch the walls, right? It's something physical versus oftentimes people see stocks and bonds or cash even as more intangible assets, something that they actually can't physically touch, and so that sometimes puts people's mind at ease that they actually can, put their hands on the thing that they own. What are some of the real estate limitations? All right. Well, once you invest money into real estate, generally it is relatively illiquid. It takes a long time. It takes a long time to buy a property, oftentimes. And oftentimes it takes an even longer time to sell it. And we're kind of experiencing that right now with a little bit of a pullback in the real estate market. So, just because you own the asset does not mean you can readily turn it into cash if you needed to. So it should be considered an illiquid, non-sellable, not ability to sell easily asset. Another issue that I find with real estate investors is concentration risk. So especially people that have a real affinity for rental real estate, they tend to have a concentration risk, meaning they have a number of properties, and those properties represent a sizable amount, sometimes even an excessive amount of their total net worth. And with concentration risk comes the risk that you're going to see a significant potential negative event in your net worth happen. So if for whatever reason we go back and we look at the 2008, 2009 real estate crisis, when financial crisis, when a lot of real estate prices were falling and they fell for a period of time, people that were overly concentrated in rental real estate saw significant decreases in their total net worth because of that fact, rather than being having a more diversified set of investments. Real estate, as I mentioned before, it requires active management, right? It requires either yourself as the owner or the management company that you contract with to actively manage a property, to make sure that you're vetting qualified tenants, that those tenants are paying their bills, that they're meeting their obligations, they're not damaging your property. Okay, so that requires a degree of active management. We all hope to have perfect tenants that leave the property in better shape than they got it, but that's not always the case. That's not necessarily the truth, and it's probably more the exception than the rule. And then, like I mentioned about market specific performance, really depends upon that location, right? So is it a desirable location or less than desirable location? And even desirable locations go through their ups and downs. You look at Florida right now, they're having a pretty significant pullback in the condo market. There's a number of factors related to that, but as compared to locations such as like Texas or Tennessee, right? So each one of these locales has their own market specific circumstances. And so one thing that you should consider when you're looking at real estate as an asset class is this real estate investment holding, is it supporting your financial plan? Or is it becoming your entire financial plan, right? And so how you factor in this particular asset class should help to support your financial plan, not become your entire financial plan, or one that causes you to not achieve the goals that you're shooting for. All right. Let's take a minute and just talk about what are the key drivers of a return on investment, okay? And particularly as it relates to real estate. All right, where do real estate returns come from? Okay, well, generally speaking, there are the two primary ones, and that is cash flow and appreciation. But also, you also have the category of paying down debt. Okay, and from from a pure net worth standpoint, okay, the asset is going to create a rate of return for return on your investment by either generating you positive cash flow. Okay, so that is the rents that, let's say, for example, the rents that you receive are greater than the expenses that you incur on the property. Okay, so you're getting a net positive rent or cash flow. And the second would be appreciation, right? So the demand for the property continues to rise. That supply demand curve thing that we learned in economics. So prices continue to rise. So you continue to see appreciation in the value of the property. So those are the two primary drivers for return on investment. But you also have this thing about paying down the debt. So, if your property has debt on it, if you used a mortgage to buy the property, then paying down that debt while at the same time that the property is appreciating in price is also creating wealth, right? So it's kind of like getting a free lunch, right? You borrowed money. Sorry about that. Thought I had turned off all of my notifications. So you've got the property is appreciating, it's generating cash flow, and at the same time, the payments that you're receiving are helping to pay down any debt that you might have on the property. All right. So those are the primary ways that you're getting a return on investment. Now, what I will say, because we focus on the tax, oftentimes people focus on the tax benefits of real estate. Which of these elements does that actually affect? Well, it primarily affects the cash flow. And the reason being is that under normal circumstances, when you receive income, you're going to pay taxes on that income. The benefit of real estate, one of the benefits is that you get tax benefits and tax deductions that lower the amount of taxes that you owe on that income. So the tax benefits directly impact the cash flow component. And to a certain extent, they may influence the appreciation element too, because more tax benefits creates a higher demand by potential investors and creates some appreciation there. So those are the elements of return on investment on this particular asset class. And so when you are making a decision about the type of real estate that you're going to purchase and how it might fit into your investment strategy, then you're going to have some trade-offs here. Okay, so it's primarily this differentiation, this trade-off between cash flow and appreciation. Okay, so if you have a cash flow focus, then you're really focusing on a higher amount of income today. Okay. Now that sometimes comes from secondary markets, and so I'll talk about that in a little bit later. But so secondary markets are markets where something is traded secondarily. Okay, so you're comparing the cash flow versus a secondary market. If you got a cash flow focus, you're focusing on something that has more stability. Okay. You are not as focused on longer term expected appreciation. If you have instead an appreciation focus, all right, then you're really focusing more on the future growth potential rather than the cash flow that you're getting today. All right. Oftentimes, those assets where you have an appreciation focus, oftentimes you're focusing on the primary markets or the initial markets. And really the way that you could kind of think about primary versus secondary markets are, if we think about a stock, an initial public offering versus buying a stock that's already trading on the stock market. Okay. So As it relates to real estate, primary versus secondary market would be if you're buying, if you have an appreciation focus, you're buying a new build. Okay, so you are putting up, you're constructing a new office space. All right, with the expectation that that office space is going to significantly appreciate over the future. That would be example of a primary market. An example of a secondary market is where I'm just going to buy this existing home that has a long-term tenant, and I know what the cash flow on that is. So that would be more like a secondary market situation. Now, if you have an appreciation focus, you're going to have more market sensitivity. You're going to be more sensitive to the ups and downs of the market. And as well dictate your decision making about what kind of return you can make on the purchase of this asset, right? Those with an appreciation focus are generally going to focus or have lower income because there is a desire to invest in the property so that it has higher future cash flows and higher future appreciation. And a good example of that would be, say, for example, for a new office building, deciding to absorb some of the tenant improvement costs in order to entice tenants to lease up your space. Okay, so if we look at the valuation of a building, say, for example, office building or really any real estate, the value that's going to be offered, what it's going to be able to be sold for, is going to be largely dependent upon how many tenants are occupying that office building. Okay, so if I can incentivize tenants to move from other buildings into my building, maybe it's worth it for me to pay for some of the tenant improvements to get them into the office, and then they're going to stay there for 5 or maybe 10 years. That provides some better future appreciation when I go to sell that building in the future. So the trade-off in this particular the thing to consider in this cash flow versus appreciation is, would you rather receive the $500 per month today, or potentially a higher equity growth over time, right? And there, for every real estate property, there's a break even between the extra amount of rent that you can collect versus the appreciation that you're going to be looking for. And every person's situation is going to be a little bit different in terms of which one they're going to prefer and which one is better for their financial plan. All right, let's talk about opportunity cost. Okay, so opportunity cost is the foregoing of the alternatives. So when you're investing in real estate, you should be comparing it to other asset classes. So, for example, if I'm comparing a property, I'm going to compare it to what are the potentials that I could get from investing in the stock market, or various stocks, or making contributions to a retirement plan, or using that money to invest in or buy or start a business, or pay down debt, or just keeping cash for liquidity purposes. Those are some different opportunities or alternatives that I could use with a given amount of cash. So, for example, if you make $100,000 down payment on a property, what are some other possible uses? You could buy a stock or an index fund. You could use it to start a business or pay down a credit card or loan. So the takeaway here is real estate, okay, or just any investment, is competing with every other use of your capital. And so when you're making an investment decisions, you have to be comparing and saying, all right, is this the best use of the dollars that I have for the purposes that I'm intending to use it for? So, for example, if my focus is on generating cash flow, okay, then I would be looking at, all right, is this particular rental property generating the cash flow that I need for my plan? And what are the other options, right? If I use that same the same amount of dollars to buy a bond or a bond fund or other types of investments, we're comparing it against the trade-offs. Okay. And so you have all these competing factors that you have to include in your decision-making process. All right, so financing and leverage. Okay. So it's basically anytime I talk about financing or the term leverage, I'm primarily talking about using debt. Okay. And really, debt is a double-edged sword. It can be debt is like fire. I kind of jokingly say, debt is like fire. In a nice little campfire, you can use it. Provides you some warmth, keeps you warm and nice and cozy. You can make some s'mores with it. Have a tasty dessert. In the bad side, it can start a wildfire and burn down your house. Okay, so it has to be used with respect and caution and control. Some of the advantages of using debt or leverage is that it allows you to purchase and control more assets with less cash. Okay, so if you can buy a $500,000 rental home with $50,000 or $100,000 down payment, well, now you've got this $500,000 asset, but you've actually only put up of your own money $50,000 or $100,000. So you've leveraged your investment. And so if that investment appreciates, you're getting a higher rate of return on your smaller investment versus if you had to buy the whole asset outright with all cash. So it helps you to amplify your gains, allows you to preserve your own liquidity while still benefiting from owning that asset. The downside, the risks are it amplifies your losses, right? It's like being on a lever, right? So if I invest $50,000 or $100,000 as a down payment and I purchase that property for $500,000, okay, and now the property has gone down by $100,000, right? Then I've effectively lost my entire investment, even though the property value has only decreased by 20%. Okay, so it amplifies your losses, can provide cash flow pressure, right? There are interest rate risks that come with this. We'll talk about that a little bit, but as interest rates fluctuate, there's the trade-off of, okay, if I take out a 7% mortgage today, but interest rates drop to, in a month, well, I've locked myself into a debt payment that has higher payments than I could have had if I had just waited a month. Okay, and then refinancing challenges, right? So people often assume, all right, I'm going to go buy this property and I'm just going to be able to borrow the loan or get the loan. That's not always the case because the lenders, the banks, are looking at the cash flow and the ability and likelihood that they will get repaid. So even if on paper it looks like a perfect investment, you may not be able to get the financing because the banks look at it as too risky of an investment. So again, double-edged sword. So key takeaway here is that using debt allows you to potentially leverage your losses, leverage your gains, but also magnifies your losses. So just keep that in mind. On interest rates, okay, the financing changes the math, right? So if it changes the monthly cash flow, it impacts your required rents, which impacts property affordability and the return that you get on that property. right? As well as being able to refinance it. So example, the difference between whether or not you can get a 4% mortgage versus a 7% mortgage. So right now, in today's markets, for a primary residence, you're looking at about a 7% mortgage, right? Used to be a few years ago, you could get, a 2.5% mortgage, and those days are gone. I don't think that they're ever coming back. So, is it a possibility that we'll get back to 5%? I think it's reasonable. All right, 4%. Then it may not be maybe a long time before we see those rates again, but who knows? The markets are dynamic, so I don't want to be too much of a Debbie Downer on this topic. So, but interest rates matter because it influences the cash flow and the ability to finance the deal and whether or not it makes sense. Okay, so. Real estate tax advantages, right? What are some of the tax benefits that we were talking about? The biggest one, at least the biggest non-cash tax advantage, is depreciation, right? We generally cannot depreciate our own homes. What is depreciation? Okay, so depreciation is an accounting term or accounting concept that when you buy a piece of equipment or something for the purposes of creating a business. Okay, so if I buy a truck and I drive that truck 500,000 miles, well, you can actually assume that I'm going to incur more maintenance costs and repairs and those types of things the longer I drive it and the older the truck gets. The same concept can be applied to real estate. Older properties are going to require more maintenance. Okay, so the IRS allows us to depreciate or take deductions for the realization that properties, investment property, whether that's a truck, piece of machine, or a piece of real estate, they have a useful life. Okay, so generally speaking, you can depreciate property up to 27 and a half years. That number changes from time to time based upon the whims of Congress and tax codes. But just depreciation in general is a concept that can be applied to real estate. But you also have other deductions that you can take on real estate. You can take mortgage interest as a deduction. So if you leverage the property, at least you get a benefit of deducting the interest. You can deduct the expenses that are incurred with repairing the property, right? If you got to replace the carpet, you can deduct it as an expense. Property management, the fees that you pay in order to properly manage a property is in a deductible expense. Okay. Insurance, property taxes, those are all things that you can deduct from your Schedule E if you're owning this as a sole proprietor, as an individual. You get to deduct those expenses. Okay, that provides more cash flow to you. You also get the benefit of some of these pass-through provisions, okay, such as the I forget the 199 exempt deduction. It's basically a small business deduction. So anyway, you have these various real estate advantages that reduce your expenses, your tax expenses, and improve the cash flow of the business. Okay, but just mind you, let's not let the tail wag the dog. Just buying or keeping an investment property for the tax benefits may not necessarily pan out from a return on investment strategy. So tax benefits should enhance a good investment. They just should not justify a poor one. Okay, moving on. So tax considerations when selling. Okay, many investors underestimate the taxes that they are going to incur when selling an investment property. So some of those taxes, right? So primarily you're talking about capital gains taxes. So an investment property, an investment of that is purchased for gain, whether it's rental property, a stock, bond, or otherwise. If you just purchase an investment and that investment appreciates, then you sell it, then you're going to incur a capital gain, and you're going to likely owe a capital gains tax. Okay, so that is on the selling of the property. That is different than the ongoing income taxes that you pay on the rental income. Okay, so we're distinguishing between ongoing income taxes and capital gains taxes. So if you purchase a property and you're charging rent and you have a net positive rent, you're going to owe income taxes on that income. Okay. That income gets offset by some of the expenses that you are incurring that we just went through, but you're paying income taxes. When you sell the property after it's appreciated, hopefully the property has gained in value. When you sell it, you've made a positive gain, and you're going to owe capital gains on the difference there. You should also, that's at the federal level, you should also factor in state taxes. And state taxes may either be in the form of income taxes, such as that we have in California, that you could have state level capital gains taxes, or you may not have any taxes. Sometimes states will not charge you for the sale of property. It just depends upon the state that you're in. One thing to note when I was talking about depreciation, and it's an important factor, if you sell a rental property, okay, and you have been depreciating that property, when you sell it, the depreciation is going to be recaptured, and it's going to be recaptured at ordinary income rates. Okay. So basically what's happening here is the IRS is saying, okay, you're getting to write down the value of this property on an annual basis, right? So year over year, you're able to take a deduction related to depreciation. But then when you sell it, they say, okay, well, we offset your taxes on those years. Now you don't get that gain. You don't get to take a capital gain tax. You have to recapture what you depreciated, pay taxes on that, and then any amount above that, the amount that you depreciated, that will be taxed as capital gain. So it is important to talk to, before you sell a property, it is important to talk to a tax professional so that they can give you a clear estimate about what your tax liability is going to be based upon how much depreciation you took. So if you've owned a property for, say, 30 plus years, and that property has now been fully depreciated, the likelihood is that you're going to have a significant amount of depreciation recapture when you go to sell it. So just be aware of that. One other factor here too is net investment income. Okay. When you sell property and incur capital gains, it will count as net investment income for you and could potentially trigger the net investment income tax on the sale of that property. So again, talking to a tax professional. I will also note sometimes people will make the decision, especially if they own the property as themselves, as individuals, or as a couple, maybe in their revocable trust. If you die and leave that property to your heirs, oftentimes you will get either a partial step up on your share or a full step up in the basis of the property, meaning the value that is taxed gets stepped up to the value at your date of death. And oftentimes that means that who you leave the property to will not have any taxable gain. They'll be able to sell the property without and not have to pay any taxes on the sale. Now, there's a lot of nuances that come with that, but that is a a frequent reason why people will hold property until their death rather than choosing to sell it, because otherwise they have to realize the taxes that come along with the sale. Okay, so the real question here when you're deciding about whether to sell is going to be how much of the sale proceeds are going to actually remain after you've cleared all of the taxes and all of the other expenses, such as the mortgages, right? What's the bottom line going to be, the cash in the bank account after you sell the property? And that's ultimately going to be the amount that determines your true return on investment, right? So if you end up with $100,000 in your pocket after, the purchase and sale of a $500,000 property, then you've got a 20% return. Okay, so it's important to do the math. All right, so when does being a landlord stop working, or when should you consider no longer being a landlord? Well, this oftentimes happens after people have been landlords for a while. They're they know what they're dealing with, and they just get tired of it, right? So when you're having constant tenant issues, right, you've got increased maintenance demands. You're constantly getting called for fix-its, having to put money into the property for repairing various things, right? You've got poor cash flow on it, right? You've got significant amount of equity trapped in the property, okay? That your lifestyle changes, particularly if you're managing a property close by and you decide that you're going to move to maybe a different state. Well, managing that property from afar comes with some additional costs. Either you have to fly over or travel over periodically to manage the property, or you got to hire a management company. Retirement transitions, right? So sometimes the work of managing the property is something you don't want to do in retirement, or just losing interest in managing the assets, right? So the luster of being the landlord wears off. And the point here is that a successful investment today or for the next few years, it may not necessarily be the successful investment that you envisioned in the future, but it also might be. I mean, if it's something that you're passionate about, you like doing it, you like the benefits of it, then maybe you keep doing it, or it's a personal choice. Okay, reasons to not become a landlord, right? So real estate, particularly directly held real estate, is not for everyone. If you dislike operational responsibilities, if you do not like getting called on the weekends or at night for things that break, then you probably don't want to consider this. If you need liquidity, right? If the idea of tying up a significant amount of your net worth into a property that you may not be able to either sell or finance for a period of time is a concern, then this may not be for you. If you cannot handle financial volatility, right? I mentioned that rents have recently softened. They were going up pretty strongly for a few years, and now they've softened a bit, right? Well, that happens over time, and you have to be prepared for that. So if that's going to be a concern for you, probably this is not the right asset class for you. If you lack adequate reserves, if you lack adequate cash reserves, the last thing you want to do if you're going to buy a real estate property is to put all of your discretionary cash into this property, because undoubtedly there is going to be things that break. You're going to have to come up with the cash to fix, right? So you need to have adequate reserves to be able to handle those things if you are going to invest in real estate. If you prefer fully passive investing, meaning you just like to collect the check and not have to manage or worry about things, then probably don't want to become a landlord. Okay. And lastly is if you already have significant real estate exposure. Now, this one's a little bit of a question mark, because if you have significant real estate exposure, if you've already got a number of rental properties, then you are familiar with it. It may not be as much of a lift to add another property, but it might be. right? And like I said, having that over concentration in a one asset class creates an excessive amount of concentration risk. Not necessarily my suggestion. My general recommendation for concentration is no more than 20% of your net worth in any one single asset class. Now, if you're, a heavy investor in real estate, I see that frequently that they exceed that, but that's just a general guideline that helps to, reduce that concentration risk that I was talking about. All right, so exit strategies. So a couple things I alluded to some of those earlier when I was talking about taxes. So exit strategy number one, sell and reinvest, right? So this is selling the property, taking the net proceeds and reinvesting it into something else. That could be another property, but that also could be stocks or bonds, other types of private investments, funding a retirement account, or other types of income-oriented strategies such as annuities or other things. So basically just selling it, covering whatever the tax liability might be, and then reinvesting the proceeds. So, what are the benefits, right? Generally, it's increased liquidity, right? Portfolio diversification, less management responsibility, and easier estate planning. Risks are paying taxes that we've talked about, selling at the wrong time, interest rates moving against you, and then underperformance of the investment that you choose, right? So there's no guarantee that, selling this particular property turns into a better rate of return if you diversify it. So exit strategy number two, a 1031 exchange. And if you're not familiar with a 1031 exchange, effectively what this is, the IRS gives you the ability to exchange like-kind properties. It used to be once upon a time you could do that for multiple types of assets. Now it's just for rental real estate or just for real estate in general. Okay. What does this allow you to do? What does a 1031 allow you to do? It allows you to defer the taxes and continue the investment. So an example would be you want to get out of this one property because you don't think that the location is good anymore, but you don't want to pay the taxes because you have fully depreciated it and you have a significant amount of gain in the property, untaxed or unrealized and untaxed gain. Well, what happens is you exchange that real estate property for another property, and you're able to defer the taxes and continue the investment. There's lots of different ways of doing a 1031 exchange. So what are the benefits? Again, tax deferral, portfolio repositioning, geographic diversification. So you could go from one property to maybe a multiple rental complex. You kind of diversify the risk that you have from a single renter to maybe multiple renters. These things, 1031 exchanges, are complex. There are strict rules and deadlines, and it does not eliminate your real estate exposure. Important note, for those that are considering a 1031 exchange, it is complicated. It is a complicated process. So please, please, please consult a tax professional and somebody that is knowledgeable in conducting 1031 transactions before you initiate one. And I will say an important note here is if you sell the property and you take possession of the check in your name before doing all the steps required for the 1031, you have eliminated your ability to do the 1031. Okay. So that's why it's important to talk to a qualified intermediary, is what they're called. Somebody that's familiar with doing these things. Talk to them first. Otherwise, you may shoot yourself in the foot and not be able to actually do the 1031 and will be stuck paying the taxes that come with the sale. Okay. So warning noted. So let's take a step back out for a second. All right. So as we're crafting your financial plan, right? Key question here is, does the real estate align with your financial goals, right? Does it support your financial goals? Are you earning an adequate return on the investment and the effort in managing that particular asset? Is it appropriate? Is the risk level of this asset appropriate for your goals and financial objectives, right? Question to ask yourselves is, if I were, would I do this again, right? Would I buy this property again today? Would I make the same decision? And if the answer is no, well, then that might be the answer to what you should do with the property, right? So, what role does this asset play in retirement? I want you to envision yourself in your late 80s acting as a property manager. Is that something that you envision? And if not, then and you own that property or properties, you might want to consider designing a trajectory, a plan for how you intend to exit those manager responsibilities. Okay. All right. So let's end with a case study. Okay. So question here is this rental property a good investment? I'm going to give you some details, right? So you have or you're talking to a couple, friend, maybe it's a friend of yours that they own or you own this 2,000 square foot, 3-bedroom, 2-bath house. The house is near schools and shopping centers, which is appealing. The original purchase price 10 years ago was for $300,000. And Zillow says that the value of your property today is $800,000. And you are collecting $2,500 per month in rent, which I think is probably a fair rental price for a 3-bedroom house these days. Your original mortgage was for $240,000 at 5% over 30 years. That suggests that your mortgage payment, at least the principal and interest of your mortgage payment, is about $1,290 per month. You've got taxes and insurance escrowed for $410 a month, and the house has some HOA fees of $300 a month. So your total payment is $2,000 per month. It is owned by a married couple planning to retire in 2 to 3 years, and you have expected appreciation of 3 to 5%. So I don't necessarily expect you to know the answer off the top, what the numbers say here, but different people will focus on different elements of whether or not this is a good investment, right? So I just walked through some of the details, right? So we've seen $500,000 of appreciation, at least according to what Zillow says, versus the purchase price, right? So that's pretty sizable amount of appreciation, okay? But you're renting it for $2,500 per month, and your expenses are $2,000. So net, right? You're making about $500 per month or $6,000 per year. That's probably not so great. Now it's appreciating 3 to 5% per year. So that's pretty good, right? But what I will tell you what the math says, just on the gross rent, you're making less than 2% on the cash flow, okay? So the $2,500 per month, you're making about 2% per year on the value of the property as it stands today. All right, that 2% plus the 3 to 5% appreciation, well, maybe that's a reasonable growth. But again, it gets back to comparing against opportunity costs. So if instead I could take that $800,000 after taxes, maybe it's, I don't know, $700,000, and pay off the mortgage, what's left of it. So maybe I'm netting somewhere around $500,000 and put that into the bank or some sort of other type of investment. Is that going to provide me a higher risk-adjusted rate of return than I could get by keeping this property. I don't know, based upon the case right now. But also, if we look at it, so if you were a cash buyer, would that change the dynamics? If you didn't have that mortgage, at 5% per year, would that change the dynamics of this investment? Certainly, it would, right? Would it change the decision-making process? I don't necessarily know. Or another way to look at this, what if you owned the property outright because maybe it was inherited, right? So different factors to consider when you're looking at a rental property investment. All right, I'm just going to close off here, summarize, right? Some key takeaways here. All right, real estate, okay? It's one tool. It's not the plan itself, right? Cash flow, appreciation, and leverage, they all matter in these decisions. Make sure you take into account tax considerations, right? Don't just pay the tax bill when it comes the next year, right? Sometimes those can be painful. Consider your exit strategies, right? Especially if you've got a long trajectory on this, you've got some time to plan. The best decisions are the one that align with your financial goals, right? This should be an investment that supports your financial objectives. All right, that is all I have there. I've got a few minutes for any questions that anybody might have. Let me make sure that I don't have any other things to cover down on. Like I was saying when I started, if there are any additional details that you would like me to elaborate on further in a future webinar, I'm happy to go deeper in this. This is intended to be more of a high level. How does real estate factor into your financial plan? There's lots of little holes that we can go down to in terms of all the various aspects of real estate investing that I won't necessarily cover today. All right, if there are no questions, I will just summarize what's coming up ahead of us that you can look forward to. The next monthly market update is going to be scheduled for Wednesday, August 12th at 11 a.m. You can look for that. And the next educational webinar is going to be scheduled for Wednesday, August 26th at 12 p.m. That one is going to be on protecting yourself from scams and cyber threats. So titled Don't Let Them In, protect yourself from scams and cyber threats. So mark your calendars for that. We'll send out an invite ahead of time if you want to join us and you want to register for that. With that, I will end today's session with a big thank you for joining me. Thank you for watching. I appreciate everyone's support in doing these, and just keep the suggestions coming. Okay. All right. Enjoy the rest of your summer, everybody. Take care.